All right, welcome back to the deduction desk. I am Joe, Wealth Management. This is Sagar with the accounting firm CPA. And today we're going to be reviewing retirement planning for businesses and how to save money. All of us, to some extent, have an idea of how our businesses have the ability to save money through retirement. But what do each of those type of retirement plans mean? How do they work? Which ones make the most sense for my business? And then at the end, we're actually going to put an example together to give you an idea of what the savings from a tax perspective will be for an individual or an example client that we have. Obviously, to get started, let's talk about why retirement planning matters for businesses, right? From a perspective of, I think a lot of business owners in their mind is, I'm going to build this business up. And majority of the time, depending on the business, it's sellable, right? You can sell the business, right? So if I'm going to sell the business in the future, that's going to be my retirement. But what advantages would make sense for setting up a retirement now as compared to your plan solely being the sale of my business is going to be retirement?
Yeah, well, first of all, welcome to Light Blue Day.
Yeah, listen, we woke up this morning. We're like, light blue's the color.
There's a lot of reasons why you should be putting money into your retirement, right? I think it's common sense to say you should save. Everyone, since the history of time, try to save a little bit of money, right? I think a lot of people rely on the Social Security safety net and having a 401, I'm putting something into my 401k, or I'm getting a little bit of a match, I should be okay. Or like you said, I'm going to sell my business, I'm going to sell this property and go move somewhere else.
Right.
And I think that, it's great. There's nothing wrong with that strategy, but you can't rely on Social Security right now. If I look at the tax bill, it seems like to me there's a lot of incentives towards people who do some of the savings we've talked about in our previous videos, like the BBB video. We talked about how there's a savings plan match and there's a Trump savings plan for the kids. And there's all these things that are being set up, which when I look at the writing on the wall, it makes it seem like there's going to be at some point a cut to all of these social safety nets. If you listen to what Elon Musk was saying when talking about trying to reduce the spending, he said our biggest expense as a government is entitlements. And there is a concerted effort from certain parts of the government to start cutting these entitlements. So at some point, I do think, if
there's going to be a change.
Yeah, if we keep going the way we're going with the way that we're spending.
Look at RMDs. Yeah. Went from 70 and a half to 73, now 75 years old if you don't hit 73 by 2033.
Right.
So there's so many different changes that are alluding to the inevitable result of something is going to change.
They want you to work longer,
more
more years. You're going to have to wait longer to take money out of Social Security. Social Security may not be around in the future, right? So you have to do this for the sake of yourself. And we can get all upset about it for sure and say, hey, we paid into it. Where did it go? But at the end of the day, if you're not looking out for yourself, I don't think anyone else is.
Yeah.
And the biggest thing you could do to look out for yourself is put money away for the future.
Yeah. And so, a couple of topics, right? There's a couple of things that probably will resonate with a lot of people now as far as, all right, I get all that, but I still have an idea of what my future plans are going to be. Number one, it has the ability to reduce your taxable income now, which is an example and something we're going to get into as we get closer towards the end of the video. Secondly, I think it's very overlooked is attracting and retaining good employees, right? Employee retention is huge. And for your ability as a business owner to say, well, I'll put a couple thousand away as a match or a couple thousand away for an employee to make sure that they stay. I've always put business owners in the scenario of you have an executive employee or you have a very good 2 or 3 employees that are doing their job very well. They've been with the business for a long time, and now all of a sudden you said to yourself, well, how much would you pay to make sure that they didn't leave? Or if they left, what dollar amount would you put towards making sure they would stay, right? Yeah. And I think the answer to that is, well, how much of my time is now going to be spent on doing their job?
Yeah.
Right? I relied on them to do a good part of my business's job, and now they're gone. Now it's taking my time away from expanding the business. So it's thousands of dollars that I would spend to make sure that they stayed here. And sometimes just as simple as setting up a match on a 401k makes a big difference in an employee deciding, should I go to another, for example, accounting firm? Should I go work at another accounting firm? They're going to pay me $5,000 more. $5,000 to some people would be beneficial beneficial and an increase, but then I'm going to lose 10,000 in my 401k. Not worth it.
Yeah. Well, and then also you look at the difference between if I can save $20,000 in my taxes, but I have to pay $5,000 to my employee, that should be a no-brainer.
Right.
And those are the types of scenarios we'll look at here. So everyone agrees retirement planning is important, right?
Yeah,
Everyone agrees that we should do this for good common sense. Now, what if you can also get a giant tax benefit for it?
Yeah.
And that's the point 100%. Of this, right? So, there's a couple different options here that you can look at. There's simpler things like a SEP IRA or just a traditional business simple IRA. The SEP IRA, once again, this is all going to depend on the type of entity you have, whether you take payroll, whether you're a single member LLC or an S Corp. So, we're not going to get so much into the different permutations of everything, but more the general concept of how it works.
Sure.
And then seeing what works best for you. As always, like we always say, talk to your accountant, talk to your financial planner, talk to somebody about what the best plan for you is based on what's available, but we're going to give you all the different ideas that are out there. Very quickly, a SEP IRA. That's just a simple setup retirement plan where you take 25% of your self-employed taxable income, which is either the profit in an LLC or the W-2 you run for yourself in an S Corp. Because if you guys remember, S Corps, there is no self-employment tax. So it's just the W-2. So if you run a $100,000 W-2 for yourself, you can go ahead and put another $25,000 into your SEP IRA. If you have a LLC that makes $150,000 a year, you can put $40,000.
I was like, you made that harder for yourself. Just leave it 100. Right? Yes.
You can put that $40,000 into the retirement plan, right? So basically, the way this works, 25% of whatever the end bottom line is, either the profit or the W-2 you draw for yourself, that you can put away. It's an additional tax savings. Whatever grows in any of these retirement accounts that we're going to talk about, aside from the Roth 401k, whatever grows in there is all going to be also tax deferred. So you don't pay any taxes on the growth. If you're day trading, having one of these accounts is super important because you
don't realize any of the gains.
You don't have to realize any gain. So you're continuously cycling your stocks. If you're holding that same stock in your regular trading account, you're paying taxes. Just a little tip here. There was Peter Thiel. He used his Roth IRA to purchase a bunch of his shares of PayPal before it went public, like right when the company was started. When he exited, he made billions of dollars tax-free in that Roth IRA using some of these strategies.
Yeah. Well, and this SEP IRA in particular is ideal for solo businesses, right? Individuals who run the business themselves. Maybe it's a husband and wife, maybe it's a small group, family, micro business. And the reason for that is because you have to participate equally every employee that's part of your business. So if you're putting away a certain percentage, that same percentage for your employees has to be done. You'll start to see more of a grander scope of different types of retirement plans are available. This is the most simple one you can set up from a cost perspective and from a, just putting money away itself. SEP stands for Simplified Employee Pension Plan, but it is because you are putting away a 25% flat base if that's the amount you decide for you and for every employee. So that's one thing you want to keep in mind. So now let's say we don't want to do that, right? Let's say we get to a position where you say, well, I have 4 employees and I'm not really interested in putting 25% of their income into a SEP IRA. Well, then what other options do we have, right? The next one is a simple IRA. And although SEP stands for Simplified Employee Pension, simple IRA is different. And a simple IRA has different rates, right? Different opportunities as far as what you can put away.
It's a flat, right? 16,000 flat. You don't have to do any math. You don't have to calculate. Or maybe you have a business that made only $20,000. You can still do the full 16.
Yep.
So this is a better option for if you're a lower earner or you have a business that's not earning a lot of profit. The simple IRA is probably your better option there.
And you're not going to be putting away as much money as you would if you wanted to put into a 401k, right? So to Sagar's point, if you have a lower income business, or maybe you said, hey, look, I'm probably going to put 5 to 10 grand away. I'm not really looking to put a much larger dollar amount or 25% of my income, then this would be a good example.
Also cheap to set up.
But it's the simple and the SEP are probably the 2 least expensive, up and above the one more that we're going to go into. The one thing about simples that is important is that there's there's a required match that you have to contribute to your employees, regardless of the amount that you're putting in. It's a set match, and those are things that a third-party administrator or your advisor will help you with, depending on the business and how you set it up. We'll structure it that way, but it is much lower cost than setting up a 401k or some of those bigger plans.
And then just really quickly, we also have the solo 401k. That's a great option if you're a single member LLC, just your own little side business that you started, or you're a 1099 contractor that gets paid in your personal name. This is another great option, right? It's your typical 401k, if you work a W-2 job, you could put $23,000 and then your company will match something like 3-4%, depending on the company. This allows you to put up to $76,500 if you're over 50, $69,000 if you're under 50. And this is, once again, a simple thing you can set up. There's calculations that go into it. It's not as straightforward as, hey, you can just put $69,000 away, but that's way more than the 23 you would be allowed to put away if you're, just working regular.
Yeah. Or an example, if you have a business that maybe your income is $30,000 or $35,000, but 25% of $30,000 is not the 69 or 70 that you could put away in a solo K, right? So that would be a difference why you would set up a solo K compared to setting up a SEP. And the other difference in a solo K compared to a traditional, right? Because there's some people out there that'll say, well, a solo K is a traditional 401k. And yes, that's true. But the biggest difference is in a solo K, if you are the only employee, or if it is you and your spouse, you can set up a solo K, which doesn't have as much third-party administration cost, tax filing costs until you get to a certain limit of contribution into the plan. So those are things that a solo K makes a little bit easier. That now transitions us into a traditional 401k.
Yeah, and then you have the traditional, right? This is where if you have employees, this is what you see in your normal businesses. If you have less employees, or if you're an S Corp, or you maybe have just your family members as employees, you may want to do the maximum match. Once again, now you're going to be able to do up to that $70,000 number, the $69,000 number for everyone that's working there. We're talking about a husband and wife working in a business together. We're putting away damn near $140,000 without paying a single dollar in taxes on that. If you're in the highest tax bracket, that's saving you what? Close to $60,000 a year in taxes?
Yeah, and we'll see that example soon. From a traditional 401k standpoint, and we're going to go into a little bit bigger plans as well. But from a traditional 401k standpoint, that's going to be the type of plan that allows you to have the least responsibility to fund for your employees. If you said, I don't want to put a very large dollar amount away for my employees, but I do want to put some money away for them, a traditional 401k does a very good job. And then depending on how much you're putting away, there's a safe harbor match that can be or should be put onto those plans in order for you to safely put away the right amount without the plan being top heavy.
Yeah.
And these plans are very complicated. And that's why you're working with experts in the financial field and the accounting field to make sure that what you're setting up and what is setting up, you understand the cost and you understand what the benefit's going to be. But these are some of the simpler plans that you can set up that'll help benefit your business from an individual standpoint, and then also from a employee retention standpoint that we talked about.
Yeah, and like with all things, the more complicated it is, the more opportunity for tax savings there are. Right. Yeah. So these are complicated for a reason. It's hard to navigate, but the amount of savings, it's undeniable. The reason I love retirement plans, and I say this all the time, it's the only way where you are able to keep every dollar and still save money on the taxes, right? If I tell you go buy a car, you go buy a G-Wagon, great. You saved on the G-Wagon, but you still spent 65 cents to save 35 cents of taxes, right? You spent $1 to save 35 cents. In this case, you're taking every single dollar, you're putting it into your own pocket, into your retirement, and on top of that, you're getting a tax break for it. There's nothing else that beats retirement planning when it comes to saving money on your taxes. And as a part of this, the government wants you to do this. Why? Because they're giving you incentives to do this. They're giving you $5,000 back per year on the cost of implementation. So if you're paying a company to set up these plans, you get $5,000 for it. If you are doing matches for your employees, you get $1,000 against the safe harbor matches you're doing. I'm not sure about these auto enrollment, but I see that there's some credits for that too. You get some $500.
Yeah, so depending on the state, depending on where you are, auto enrollment in 2025 was something that was required for you to set these plans up, so that you would have to tell your employees to opt out of it as opposed to asking them to opt into it. And that's more stuff that that we'll get into.
This stuff's all fine and dandy, right? And I think everybody knows about these things, and pretty much every accountant's going to tell you about this stuff. The things that are more powerful, the things that we see that we think can make a big difference in your personal tax situation, are the defined benefit plans and the cash balance plans. So these are types of pensions that exist, and they are awesome for somebody who is a small employer that earns a lot of money, right? If you have less, maybe if it's just you as an employee, or you have a couple of family members, or even if you have a few really dedicated, loyal staff, and then you subcontract out a lot of your other work. Construction people, for example, are great for this. This defined benefit plan, ultimately, the way it works is
that's the next one, right? The defined benefit plan. That's the DB plan, defined benefit plan. That's the highest level plan that you can put in.
You're putting away up to $300,000 per employee. So, and you can use them in combination with the 401k or the SEP. So on top of the regular retirement, you can add this as an additional layer. So it's a husband and wife running a business. That's $600,000 to $700,000 a year that they're able to put away.
And obviously, this is meant for higher net worth, businesses that, are making a large sum of money, and maybe they're not taking it in payroll, but maybe they do have a big tax burden from their business's standpoint. And they say, what other tax strategies will allow me to take a bigger deduction? These defined benefit plans work as a traditional pension. And so what the IRS says is, depending on your age and depending on your income, we will calculate, and usually an actuary is someone you need to hire. So an actuary will determine what dollar amount you have the ability to put away based on your income and based on your age and how much time you have before you're actually going to retire. But those numbers can be big if you're 45, 50, 55 years old and you said, look, I have 6 or 7 years left before I'm going to retire. You would need to put a significant amount of money away in order for you to get to the goal that you wanted to get to. Then that's where these defined benefit plans really start to kick in.
Yeah, it's great for someone who's consistently making good income, somebody who struggles with really high tax bills every year, doesn't have a ton of things they can deduct, right? So lawyers, accountants, professional service people, doctors, even construction people, plumbers. These are folks who have lots of high income, consistently high income, and there's not a ton of expenses, right? You're using your brain or your physical labor or your skills and things you've developed yourself. You're not selling a product. You have a high profit margin and you have a high taxable income. So this is a great way to put money away. And one of the best things about it is, well, let's say, I get this all the time from clients. They say, I'd rather keep the money liquid and pay the taxes because I want to reinvest it, or I want to put it into other projects, or I want to put it back into my business. Well, if you do it right with your defined benefit plan, there are many instances where you can access that money to reinvest into other businesses, to buy properties, to buy alternative investments, not just stocks, with these defined benefit funds. So once again, that's a little more complicated and it gets into a lot of different details, like having a trust set up through that, having the proper administrator, getting valuations done, but it's possible and it's something that exists. And certainly if your concern is, hey, I would love to put $700,000 away, but I may need that money in the future. Well, you're in luck because you're able to tap into that. If you need to.
There's some opportunities there. And from a cost perspective, right, we're going from the least expensive way to accomplish retirement, SEP, simple, solo K, to the most expensive, which is the defined benefit plan, right? Defined benefit plans require actuaries to run the plans. They require tax documents each year to make sure that you're keeping up with the dollar amount that you can actually contribute each year. And there's a lot more details that go into those plans, and that's stuff that, if you were interested in learning about it, obviously you can click the link in here a little bit more, or talk to your tax professional or your investment person, and they can definitely help you a little bit more in that area.
Yeah. So I think, this is obviously a lot of stuff that we've thrown at you. You may watch this video multiple times to try to grasp everything, but we want to try to lay out a scenario and a case study that I think will make things a little more understandable for a lot of people, and how we're going to utilize multiple different portions of the strategy. This particular strategy, especially with the defined benefit, is definitely aimed more towards people who have higher income, right? So I think it's important for everybody to know about this, and hopefully everybody's, if you're not in that highest tax bracket yet, you're moving towards it. But this is, for those of you who are, I think this is extremely important, and you should stick around for this case study that we're about to do.
Yeah. So we'll start with a couple things. Number one, an S corporation, right? You want to dive into that just a little bit?
Yeah. So we were going to use an S corp because we would tell anybody who's making $1 million a year
in revenue
that they should have an S corp, right? Or depending on their state, there may be some states we don't want to do that in, but generally speaking, we're going to want to be an S corp. So in this particular case study, we have an S corporation. The profit after all expenses before retirement is $1 million. We're also going to say that the owner, who is required to take a salary, is taking a salary of $200,000 a year, and that they have an employee who is much younger than them, that's 35, the employer is 52, let's just say. The 35-year-old employee is taking a salary of $100,000 a year. Right. So now, what are we trying to achieve here, right? We're trying to reduce our fed and state taxes. We're trying to build up retirement savings, and we want to make sure that everything we're doing is legal and compliant. So the first thing that we would look at is setting up the defined benefit plan. Right. So we see that based on this information, we would hire an actuary, Joe. In our case, if I had a client that wanted to do this, I would have Joe running all the point on this.
Yeah.
And he'd be setting this up.
And we'd be communicating. Yeah. And we'd be communicating with third-party administrators. Obviously, each one have different costs and different services. So those would be things that we'd speak about in order to make sure that it made sense for you and your business. And
as we mentioned, whatever those costs are, get reimbursed as a tax credit on your personal tax return with these new laws, up to $5,000 of that. So, while there are costs of running these things, the nice thing is you get a credit for it.
Let's go through it, right? So S corporation, $1 million in annual net profit before putting money into retirement after expenses from the business. Owner is 52 years old, makes $200,000 a year. Employee is 35 years old, takes a salary of $100,000 a year. So right off the bat, a defined benefit plan is a contribution from the business, right? It is not an employee contribution. It is not a contribution that someone decides. It is something the business decides to give to their employees. So in this case, the owner, the 52-year-old, and the employee, the 35-year-old, are both employees of the business. So the business makes an owner's contribution of $155,000. And those contributions are dictated by that third-party administrator. It depends on the income. It depends on people's ages and those scenarios. But let's assume that $155,000 is going into the plan.
And that's pretty common that you see. Somebody who's running a salary of around that much, you're getting about 3/4 of it going in as a contribution. So I don't think, while we are using a hypothetical number here, generally we do see that at around a 50-year-old. For a 50-year-old, this is about how much they would be able to put away.
Yep. And so that's one part of it, right? That creates the large upfront deduction that we have the ability to contribute. But in these defined benefit plans, we also have the ability to combine them with 401k plans and safe harbor type of profit sharing plans. So when we're looking at these defined benefit plans, we may say, well, there's a large amount that we're required to do every year, but maybe we want less of a fixed amount that we want to do. And now we want to add some of these safe harbor 401k plans so that we can be flexible with some of the other contributions we're making, right? So in a safe harbor in the 401k plan, each employee's deferral is about $23,000, right? Obviously, from an employer standpoint, being over 52 years old, they can get up the catch-up provision, so they can get up to that $30,000 in a contribution amount. And then total contribution from the owner is about $70,000 between the employer, from a profit sharing standpoint, and the employee. And we talked about this a little bit, and I don't want to get too deep into the woods with it, but if an employer is putting in the maximum contribution to their 401k, and let's say their employee makes significantly less or contributes significantly less, then usually a match, or what we call a safe harbor match, would be required in order for them to make sure that the plan isn't too heavy. Heavy meaning the employer has majority of the funds and the employee has very little. We want to obviously keep it balanced so that the government requires that safe harbor match. So combining those two gives you the ability to increase the total amount that you're putting into a plan that you can deduct for retirement. Part for you as an employee, the other part for the business. And now some people may be saying, well, maybe I want to do the SEP, right? Or maybe a SEP is part of what I want to do in the plan also. And in these scenarios, especially if you're going to be doing profit sharing through a 401k, you have to make a decision on whether you're going to do a 401k and a SEP IRA. And those are really determined by the strategy that you work with your accountant and with your advisor, or all three of you put together. But in this scenario, we're going to use the safe harbor and the defined benefit as opposed to diving into the SEP.
Yeah, ultimately we're mixing these two.
Yeah.
There's one other thing we can add on, which I didn't really talk about a ton, but it's something that we'll talk about in a later. It's the HSA plan, the health savings account plan, right? This is just an additional tack on, another $8,300 that we can tack on as well, right? This is completely optional. You don't have to do this, but if we want to really maximize and get as much as we can get out of this. So I think we've probably sufficiently confused most of you. We've probably thrown more information than you need.
That was the plan, right?
That was the plan.
Just click the link and they'll tell us what to do.
Those of you who've skipped through everything and are at this part and skipped all our yapping, we're basically, here's the final impact here. $1 million of profit before you took into plan the DB and the 401k. You put them in, the total deduction came out to $249,300. And the new taxable income is $750K, right? So that tax savings, that $250,000 of reductions, where the employer was able to keep all of the money, nothing left his pocket, everything went into his retirement account. The total tax savings for them for that year was $87,000. Right? So you're basically keeping 100% of your money. You're not going and buying a car or a private jet or whatever the heck else you're trying to buy, and you're ending up with $87,000 more in your pocket as a result of this.
Down payment for the G-Wagon.
Down payment for the G-Wagon.
Yeah.
There you go.
You probably listened to this video going, how am I going to afford a G-Wagon? Well, we just
showed you, yeah.
That's how you do it. So, again, we're going to dive a lot more into a lot of these plans. We thought this was something that's definitely important for people to hear about because there's so many different intricacies with them. Hopefully we're able to clear up some more of a broad understanding of some of these plans, and definitely speak to your tax advisor, your wealth manager, your financial advisor to make sure that some of these plans, obviously.
If you don't take anything else away from this, just take away the fact that, hey, this is something I should be looking at and hiring somebody to analyze for me to see if I'm a good candidate.
100%. Thanks for joining. Look forward to seeing you on the next video. Thanks, guys.